Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to continue our lesson on interpretation of financial statement, or what we call the financial statement analysis using accounting ratios. And then what we are going to do today is that we are going to solve a question. And this question involves the calculation of ratios. And we are also going to make comments on these ratios that we have calculated, as well as advise the company. Now, we are not going to write a report. What we are going to do at this level is that we are going to take it from a lower level where you are not supposed to write a report. This is usually at the level 1 of either ACCA or IC agent, or at the first degree level, where you are just supposed to calculate the ratios and make comments on them. That is what we are going to do. And this is a past question from the Institute of Chartered Accountants Ghana, the level 1 financial accounting in the year 2021. So that is what we are going to solve. And then in the subsequent video, I'm going to take you a step further by taking you to a higher level of the level 2 and level 3, as well as the master's degrees levels, where we have to not only calculate the ratios and make comments, but we are going to write a report on the ratios to analyze the financial position and performance. So for now, let me take this question and then solve it with you as a way of enhancing your understanding from the formulas that I have taught in the previous video. Okay. The following summary information relates to two businesses, Danyi and Napo. Both businesses traded in the same market sector for the year ended 31st December 2020. So we have the statement of profit or loss for the year ended 31st December 2020 for Danyi and Napo. So these are separate financial statements for the two companies, and we are going to look at them and do the analysis. So for sales, it's 800,000 for both. Cost of sales, 400,000 for Danyi, 360,000 for Napo. Gross profits 400 and 440, and then we have expenses to be 250 and 220,000 Ghana cedis respectively, giving us a final net profit of 150,000 and 220,000 for both. And then we look at the statement of financial position as at 31st December 2020. And so for the non-current assets, we have a summary of it, a total 490,000 for Danyi, and then Napo is 700,000. And then we come to the current assets. Inventory is 50,000 for Danyi and 100,000 for Napo. 80,000 receivables for Danyi, 160,000 receivables for Napo. And then cash at bank is 170,000 for Danyi, but nothing for Napo. So Napo has no cash in hand or at bank. We move to current liabilities. Danyi payables 90,000, 140,000 for Napo, and then we have a bank overdraft for Napo, meaning that the bank balance of Napo has run into overdraft, giving us a total capital employed of 700,000 each. And then let's look at the finance by the equity and equity portion. We have opening capital of 575 for Danyi and 555,000 for Napo. And then net profit has been brought down from the statement of profit or loss, 150,000 and 220,000. And then we take out the drawings for both companies, giving us closing capital of 700,000 each. And then there is an additional information. We have inventory as at 1st January 2020. Danyi is Danyi is 30,000 and Napo is 80,000 Ghana cedis. Before I read the requirements, I want you to look at something. If you go back to the question, under the statement of profit or loss, you see that the cost of sales of Napo is lower than that of Danyi. So even though they've made the same sales value, Napo is making a lower cost of sales, giving him a higher gross profit than Danyi. And then you can also see that the expenses, the operating expenses of Napo is lower than that of Danyi. So it means that Napo is, as a result, getting a higher net profit than that of Danyi. So you could see that Napo is doing well in terms of the profitability. Now, I am saying all these things because it is very necessary that you look at it. You don't just calculate the ratios. As you read the financial statement, you need to also picture what you are seeing, okay? So that you can make your own judgments and your own conclusions before you start calculating, because that is going to give you an edge, or it will give you an enhancement in the write-up you are going to make concerning their performance. So the statement of profit or loss pictures the performance, and then the statement of financial position pictures the position. So let us go down there and look at the statement of financial position. You can also see that as for the non-current assets, is given in total. We can't talk much about it. But with the working capital issues, you can see that NAPO has so much in inventory. You see, the inventory on the statement of financial position is the closing inventory. That is why we've been giving the opening inventory in the additional information. But then there is no cash in hand for NAPO, but there is cash in hand for Danny. And you can see that the component of cash at bank for Danny is so much. Okay, so much cash in hand. But then few inventory, few receivables. And then we can also see that NAPO's cash is in overdraft. And so you can see that even though NAPO did well in the terms of the profit than Danny, when it comes to the liquidity area, Danny is also doing well. And we are going to make comments on this. Now, some of these things that I have just picked out are very important, because we are not just going to calculate the ratios, we are going to interpret the ratios. And we need to make comments that are related to what we have observed in the financial statement. Okay, so let us go and look at the requirements. You are required to A, calculate the following ratios for Danny and NAPO. So the first requirement is to calculate the following ratios. I, the gross profit margin, then the net profit margin, returns on capital employed based on the closing capital. Okay. And then we have the current ratio, liquid or asset test ratio, and then the inventory turnover. So these are the ratios. We have 3 of them from profitability, and then the other 3 coming from liquidity areas. So it means that our assessment basically is on liquidity and profitability. Okay. B. Use the ratios calculated in A to assess I, the liquidity of both businesses. II, the profitability of both businesses. Okay, so we are going to do an assessment. We are going to assess the liquidity of the Danny business, and then also the liquidity of the NAPO business. And then also we'll look at the profitability of both businesses. So that is what I did earlier. We are going to make observations, and based on the ratios, we make comments for the marks. Okay, so this one was for 4 marks each in the exam. So we are going to make an analysis on that assessment. And then the last one, C, advise management of both Danny and NAPO on the actions they should now take to improve liquidity and profitability. And so this is a very simple, for the advice session, what you are going to do is that based on the problems you identify, then you will make recommendations on what they should do in order to improve the situation. That is what the advice is all about. So ladies and gentlemen, we are going to solve this question. It's quite a detailed question. So we're going to take the first part. We are going to calculate the ratios, and then afterwards we'll come and do the analysis. Okay. We are supposed to calculate the gross profit margin, net profit margin, returns on capital employed as a profitability ratios. Now, I'm going to show you a simple way to do it in the exam hall. Now, when you go and you are doing comparative calculations like that, you need to show. Now, you need to mention or quote the formula before you calculate. So this is what I always advise. You are dealing with Danny and NAPO. So create a space for NAPO, create a space for Danny, and then you create a space for the formula, and then you create a space for the ratio. So this is what I've been doing. So for ratio, the name of the ratio, the formula, Danny, and then NAPO. Okay, so this is what you do. Create a space for ratio, formula, Danny, NAPO. And then the ratio, the first ratio we are going to calculate is the gross profit margin. So you quote the formula for that ratio once, so that you don't have to quote it for each of them. If you don't do it this way, you may calculate for Danny, and then you need to quote the formula. When you open another page for NAPO, you need to quote the formula again. All right, so the formula for gross profit margin is your gross profit over the sales revenue times 100. So this is the formula for the gross profit margin. And so what you need to do now is to go into the question and then look for the figures in the formula and then you present them. So you look for the gross profit. In the question, the gross profit of Danny was 400,000, but the gross profit of Napo was 440. So let's calculate for Danny first. The gross profit was 400,000 Ghana cedis. The sales figure was 800,000, as you can see. And so you say 400,000. So let me put, okay, so over 800,000 times 100. And that is going to give us 50%. So that is the first ratio. The gross profit margin of Danny is 50%. And then that of Napo, from the question, the gross profit of Napo is 440,000. And then that of the sales is 800,000. And so we have 440,000 over 800,000 times 100. That is going to give us 55%. So, ladies and gentlemen, we are done with the calculation of the gross profit margin. Okay. So, the next ratio to look at is the net profit margin. And then the formula is your net profit over sales times 100. So once we've quoted the formula, we look for Danny. Now, from the question, Danny's net profit is 150,000. And so that becomes 150,000 over the sales. Sales is already quoted as 800,000 times 100. So that is going to give us a percentage of 18.75. 18.75%. And then we can calculate the same for Napo. Napo's net profit from the question is 220,000. So over sales of 800,000 times 100. That is going to give us 27.5%. And so as you can observe, you can see that Napo is doing well than Danny in both profit areas, even though I'm going to add the last profitability area. But according to this question, we are supposed to make comments on profitability. And also, we also make assessments on liquidity for both businesses. And I'm just drawing your attention to the fact that Napo is doing well in terms of profit. And we need to tell reasons, because you can see that the reason why they are doing well in terms of the gross profit is that they were able to minimize their cost of sales. So it means that they are doing well in cost management than the Danny company. When it comes to the net profit margin, apart from doing well in the cost management, they also did well in terms of lower operating expenses than that of Danny. So if you have any advice to give, you should know that you need to advise Danny on how they should be able to also follow suit. All right, so let us look at the last formula under the last ratio under profitability, returns on capital employed, ROC, and is based on closing capital. The formula is your net profit over capital employed, which in this question is a closing capital, times 100. Now, from the question, capital employed is 700,000 for both companies, okay? And so we say that the net profit of Danny is already known to be 150,000 over 700,000 times 100. And that is going to give us 21.43% for Danny. And then we come to Napo. Napo's return on capital employed, 220,000 over 700,000 times 100. And that is going to give us 31.43%. And so, ladies and gentlemen, as you can see, Napo is still doing well in terms of returns on capital employed than Danny. So it's a very simple analysis to make. According to requirement B, we are going to make assessment on profitability as one requirement and on liquidity. Now, on profitability, Napo is doing better than Danny in all those aspects. It is not just enough to say they are doing better, But I told you need to make comments on why you think they are doing well. And I have pointed out to you, one of them is cost of sales, lower cost of sales, and then lower operating expenses. Okay. And it runs through. And then you can also advise these people to follow suit. So these are profitability ratios that we are going to make comments on. I am going to give you points actually from what I'm saying, but I'm just giving you a general picture so that from the question, as you can see, it will be an easier analysis to make. Now, let us also calculate the liquidity ratios, and afterwards, we'll go to the B and then make our comments on them. Okay. Now, under the liquidity ratios, the first ratio that we are supposed to calculate is the current ratio. So let us also quote that formula. So current ratio. Now, the current ratio is a ratio of current assets to current liabilities. So current assets over current liabilities is to 1. So this is the formula for the current ratio. Now, we can see from the question that for Danny, their current asset is 300,000 Ghana cedis. And then for Napo, their current asset is 260,000. And then for the current liabilities, it's 90,000 for Danny. And then if you look at 140 and 120 for Napo, it's still 260. Okay, so you can look at it and then do your own calculations. And so calculating the current ratio for Danny is going to be 300,000 over 90,000 is to 1. Okay, and that is going to give us 3.3 is to 1. A very high liquidity level. And then let's look at that of Napo. Napo's current asset total is 260,000. Their current liability total is still 260,000. Is to 1. So that is going to give us a ratio of 1 is to 1. Now, you know what it means? It means that Danny has a very strong current ratio position in the sense that for every 1 Ghana cedis that they owe, they have 3 cedi 30 pesos to pay in terms of a ratio of current asset to current liability. So is the table twisting or is the table turning around? When we were in the profitability zone, you realize that Napo is doing better in terms of the profitability. But when we go to the liquidity zone, first liquidity ratio, Danny is doing well. Napo is having 1 is to 1. What it means is that for every debt that they have 1 for 1 cedi to pay 1 cedi debt that they owe in the short term. Okay, this is not entirely very good, but let us assume that it's okay. However, Danny is doing far better. This is very bad, and you can see when we calculate the liquid ratio. Okay, so please let us understand that Danny is doing better than Napo in terms of the liquidity and having a very high current ratio. Now let us also look at the next one, which is the acid test ratio or the quick ratio. Now, the quick ratio is giving us your current assets minus inventory all over your current liabilities is to 1. So just as I explained, we are trying to take out the component of inventory to see what is the actual liquid funds we have immediately to pay apart from inventory. Okay, so let us look at that from the question. Now you can see that the inventory component of Danny is 50,000 out of the total current asset of 300,000. It's just 50,000. Okay, so if you take 50,000 out of 300,000, you are going to get 250,000. You can show workings anyway. And then with that of Napo, their inventory component of the 260 is 100,000. So if you take it out, they have 160,000 as receivable. Nothing for cash at bank. But the liabilities, we are not going to touch it. And so that means that they are going to have only 160,000 as their current asset minus inventory. And so when we come here, we can write it as 300,000 minus 50,000 over the ratio, and then we calculate it. Okay, so 300,000 minus 50,000. Or you can do the workings elsewhere and then bring 250,000 directly here. Over 90,000 Ghana cedi is to 1. Now, this is going to give us a quick ratio of 2.8 is to 1. Fantastic. It means that even if you take out inventory, Danny still has 2 cedi 80 pesos to pay every 1 cedi debt that they owe, or $2.80 to pay every $1 that they owe. And this is a very impressive performance in terms of liquidity. Now, let us look at the liquidity state of NAPO according to the liquid ratio. Now, we had their inventory, their total assets is 260,000. The inventory component is 100,000. So if you subtract, you have 160,000 all over the current liability of 260,000 is to 1. So what is going to be the final answer? We have 0.62 is to 1 as our liquid ratio for NAPO, which is very bad. You can see that for every 1 cedi they owe, they have 62 pesos only to pay in the short term when there are no inventories. And this liquidity state is very bad. It means that the company is risking liquidation in the near future. They are going to have working capital challenges. They are running into overtrading, and it's not going to help them. Okay, and so this is a very strong position. So you can see that both the liquidity positions of Danny looks far better than that of NAPO. So even though NAPO is doing well in the profitability zone, they are not performing very well in the liquidity zone. So these things gives you a lot of things to talk about. I have told you that the focus is not just on the calculation, but the focus is also on the comments you are going to make on the ratios you have calculated and what you have observed, okay, and then what you are going to say. So please take note. And then the final one we are calculating is on the inventory turnover ratio. Now, this is not inventory turnover days. This is the rate of stock turnover. And it is calculated as your cost of sales over your average inventory. Now, the average inventory is your opening inventory plus closing inventory divided by 2. So you are finding the average of the opening and the closing stocks. And in this question, we are fortunate. We have both the opening and the closing inventory. The closing inventories are those that we have on the statement of financial position. The opening inventory was given to us in the additional information, as we can see. Now, in a question where they did not give the opening inventory, you can pick the closing inventory and bring it down as your average inventory. But once we've been given, we need to calculate. So we can just do quick working on that. So we'll show workings for that. So the closing inventory for Danny is 50,000 as we have seen. And the opening inventory is 30,000. So for Danny, closing inventory is 50,000, opening is 30. So we are going to have 50,000 plus 30,000 divided by 2. So the average inventory, 50,000 plus 30,000 over 2. That is going to give us 40,000. These things are just rough work. You can do it elsewhere. Now, what about the cost of sales? The cost of sales for Danny is 400,000. So as you can see, we are going to have 400,000, which is the cost of sales of Danny over the average inventory of 40,000. And 400 over 40 is giving us 10. So the answer is 10 times. Remember that when I was teaching the formulas, I said that this rate of stock turnover is calculated in times. Okay, we are looking at the number of times we go in to bring inventories for sale. So this is the number of times in a year that you go and bring inventories. And then let's look at the inventory turnover for NAPO. NAPO's cost of sales is 360,000. So 360,000. Now let us look at the average inventory of NAPO. Now, according to the question, closing inventory of NAPO is 100,000. And then the opening inventory is 80,000. If you add 80,000 and 100,000, it's 180,000. If you divide by 2, it's 90,000. So the average inventory of NAPO is 90,000 Ghana cedis. And so 360,000 over 90,000 is going to give us 4. So that is 4 times. So in a year, we go and bring in inventory 4 different times, but Danny goes 10 times. So this is better than that, because for 10 times, it means that you are able to sell your inventories quickly and go in for more. But when you, for Danny, for Napo, when they take one batch of inventory, they stay on it for a long time before they go for another one. So once they are operating in the same sector, we can say that Danny is doing well in terms of the inventory turnover than Napo. Okay. Okay, so these are the ratios. So we are going to make assessments on them. Now, the comments we are going to make are not only based on the ratio, even though they are based on the ratios, but we also need to get an eye on the financial statement or the information we have been given. So as we make the comments, we make them in relation not only to the answers, but relation to the figures on the financial statement as well. Now, the second requirement, B, is that use the ratios calculated in A to assess I, the liquidity of both businesses, II, the profitability of both businesses. So let us first do that of the liquidity. So the assessments we are going to make on the liquidity are just observations. Just observations at this level, just observations. So the first one is that we are analyzing the liquidity first. So starting from the current ratio, you can see that the current ratio of NAPO, this is what you write in the exam. The current ratio of NAPO is very high. But you can also see that from the question, the cash at bank is too huge. Okay, 170,000. So you can also make comment that they also have idle funds. So they should consider investing the idle funds. Possibly. And then also you talk about the fact that NAPO is having a lower current ratio. When you get to liquidity, you can also mention that Danny is doing well, going very high in terms of the liquid ratio. In terms of the liquid ratio. And then you also make a comment that NAPO is not doing well. They have a poor liquidity state, and that they should, okay, if I add they should improve, that is to the advice. So for here, there is just an assessment. The advice is a requirement C. But if you were writing a report, you will not just make the observation, but you also make the advice. So just make a comment that this is what you have seen. These people are doing well. These, they are not doing too well. Then one other thing that you can observe is that you see that the receivables of NAPO is very high. So it tells you that they have a poor credit control system. High receivables means they are not able to collect their debts. So you can also talk about that. So things that is why I said it's not just about the ratio. You observe the financial statement and you see that they have a high receivables. You should talk about credit control. Okay, that they should learn how to do credit control. Now, one other thing you can talk about, apart from the receivables that are high, is the fact that they have a bank overdraft. Okay, they have a bank overdraft, and they should look at that. That you cannot operate and you don't have physical cash on you. Rather, you have a bank overdraft. That is also a serious liquidity challenge they should also look at. So the examiner expects you to just make comments on them. At this level, you are not advising, you are just making comments. Requirement C will be on the advice. Okay, now there are some requirements that will tell you to do both at the same time. So you do. So after you have done that, then you can also look at the last one, which is the inventory turnover. And you can see that this business, Danny, has a high inventory turnover, very high than ×2 of this. Okay, so they are doing better in terms of inventory management than that of NAPO. And then you also make comments on that. So these are the observations in terms of the liquidity assessment. Let us also look at the profitability assessment. Okay. Now, with the profitability assessment, I don't know what more to say, because the comments that I'm supposed to say, I made them during the calculation. Now, you could see that NAPO is doing well. This is what you are going to write. Doing better than Danny because of, so tell us the reason for observation, a lower cost of sale. Okay. Then also, when you come to the net profit margin, they are doing better because of lower operating expenses. And so these people have high operating expenses, and this ones has low. And then the company NAPO is also doing well in terms of the returns on capital employed than that of Danny, because also of the same reasons that I have mentioned. So these are the fair assessments that you are going to make. The examiner expects you to look at this and be able to tell us what you see. So the assessment is about what you see and maybe the possible causes of what you see, if they are available. And once you have been able to go through that, then we will look at the last one, which is the advice session. So let us look at the last requirement. The last requirement says that advise the management of both Danyi and Napo on the actions they should now take to improve liquidity and profitability. Now, with the advice, these are two different companies. You cannot advise the management together. So you need to take that of Napo, advise their management separately in a statement or in tabulated points. Then afterwards, you look at Danyi and then you list points to advise them as well. So we are going to advise each of them separately. So when we take the management of Danyi and want to advise them, we can look, this time we are not doing only liquidity or profitability, but a fair advice for all. So you look at where they have their weakness and you advise them. They are doing well in terms of liquidity. That is for Danyi. So I don't think there will be much advice, except maybe for you to advise them that there is too much idle funds or cash, so they should invest. So that is an advice. We'll pick that as one advice. But when we come to the profitability, we'll advise them that one, they should learn how to cut down their cost of sales. That is the first advice for Danyi. Two, they should also reduce their operating expenses. Try and then cut down unnecessary expenses in order to increase profitability. And then three, they have too much idle funds sitting in a bank. They should try and invest for investment income. So these are three key advice you can give to the management of Danyi. Very good. Then let us come to that of Napo. What are you going to say with Napo as an advice? You see that you have little advice to give in the area of profitability because they are doing well. So if you have an advice, it should be in the area of liquidity. Now, with the area of liquidity, these are the possible advice you can give. You can advise them to reduce their inventory levels. You see that when it was a current ratio, even though it was bad, but it was 1:1. But when we calculated the quick ratio, it dropped to 0.6. It means that there is too much inventory being held. So they can reduce it. If they reduce the inventory levels, okay, it's going to improve the liquid ratio. And we know that a 0.8 liquid ratio is also acceptable to an extent. Okay, so the first advice is that they should reduce the inventory levels, as holding too much stock also has its own disadvantages. So that is the first advice you can talk about. Now, the second one you can talk about is that they have a huge debtors. So you can look at the financial statement and you see that their debtors figure is relatively higher than that of Danyi. So you talk about the fact that they should improve on their credit control. Remember that we mentioned credit control as a problem. Now, take note that the advice has to be based on the problems you have identified. And so once you have assessed a challenge, then you give an advice on how to solve it. So they should improve on their credit control. That is also an advice for the management of Napo Limited. And then also, they have to find a way to pay off that overdraft. That is an advice. Pay off that overdraft so that eventually they will improve on both the current and the quick ratios. They need to improve on these two ratios. And they can do so by a proper liquidity management or working capital management system. So you can say they should put in place proper working capital management systems to improve their current ratios and their liquid ratios. So this is basically what the examiner expects from you. So after calculating of the ratios, you need to make a fair assessment on them and then also give an advice to management. I told you this is what you do at the level 1 of the CA or ACCA or your first degree or whatever level that you are writing this paper, which you are not required to produce a report. Now, in the next video that I'm going to do, which is going to be the part 4 of this lesson, I'm going to focus on those writing at higher levels as a master's degree and then the level 2 and the level 3 of the professional examinations, where you need to write a report to management, to shareholders, whatever. And I'm going to show you the kind of comments you must make in your report, and then the outline of the report and what to do and what not to do, so that your report is going to be a report that is rich enough to earn you the marks that you deserve to pass. Okay. So this will bring us to the end of the part 3 of our lesson on this interpretation of financial statements. Now, in the part 4, we are going to talk about advanced financial statement analysis, where we are going to look at how to write the report. Okay. Remember to subscribe to this channel share this video, and let others also have a benefit. Until we meet again for the part 4, it is bye for now.